G'day and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us here at ausbiz. Let's take a look at what happened overnight. Global equities, little changed essentially as investors considered stronger than expected US jobs data while remaining wary of further military action in the Middle East. Stocks on Wall Street made modest gains. Nvidia helped lift the S&P 500. However, Tesla shares reversed after the EV maker reported third quarter vehicle deliveries below estimates. Elsewhere in that sector, shares of Ford fell after reporting weaker growth in domestic new vehicle sales in the third quarter, rising less than 1% compared with more than 7% for the same period last year. And electric truck maker Nikola's shares surged after delivering more hydrogen fuel cell electric trucks to its dealers in the third quarter compared with the previous quarter. Sportswear giant Nike fell heavily after withdrawing its annual revenue forecast just as a new chief executive is set to take charge. And shares of Humana dropped sharply after the health insurer said its expected enrolment in its Medicare Advantage plans for those aged over 65 and above to decrease next year. Shares of oil and gas companies rose as they tracked crude oil prices higher, and shares in US airlines fell as tensions rise in the Middle East, with carriers around the world having cancelled flights to Israel and Lebanon in the wake of the escalating conflict. Well, on the macro front, US private payrolls increased more than expected in September in further evidence that the labour market there is not deteriorating. Private payrolls increased by 143,000 last month after rising by an upwardly revised 103,000 in August. Meanwhile, a strike by 45,000 dock workers, which has halted shipments at US East Coast and Gulf Coast ports, has entered its second day, with concerns that the disruption could be prolonged and impact the broader economy and perhaps give view to more inflation. Longer dated US Treasury yields rose after economic data pointed to a stable labour market. That's ahead of Friday's hotly anticipated non-farm payrolls data. The yield on the 10-year note was up 4 basis points to 3.78% and the 2-year at 3.63. And the US dollar has hit a 3-week high against the euro off the back of that jobs data, while it remains a favoured safe haven amid the Middle East conflict. The Aussie at 68.8 US cents. And overnight, Israel said 8 of its soldiers were killed in combat in South Lebanon as its forces moved across the border in its military campaign against Hezbollah. On the commodities front, oil prices have continued to rise on concern that the escalating conflict could threaten oil supplies there in the Middle East, but a large build-up in US crude inventories limited those gains. Brent futures rising 0.5% to $73 a barrel. Commodity prices have strengthened across the board. Copper's up 1.5%, iron ore up just shy of 1% to $109 a tonne, and gold easing to $2,657 an ounce. Meanwhile, Bitcoin, that remains below 61,000 US dollars. Well, to get across the macro picture and particularly how that's influencing the US dollar and those bond yields, I caught up earlier with Ntonifor from BCA Research.
Yeah, so I completely agree with you. We've seen the US dollar come off its highs. That has been based on the fact that US interest rates have been pared back, given that we had the jumbo rate cut from the Federal Reserve. But to be honest, if I'm looking at the next 1 to 3 months, I see the dollar rather up. You've mentioned geopolitical tensions. That's one factor, but there are a couple of other factors that I'm considering. One of them is that the Federal Reserve, according to its does not see interest rates being lowered as much as the market. So if there's some sort of a convergence between what the Federal Reserve is thinking and what the market is thinking, that will lead to interest rate differentials in favor of the US dollar. And then the second point, which is also equally important, is that when you look at the economic data that's coming out, the US seems to be holding up pretty well relative to other economies. It is possible that the Chinese economy, for example, rebounds, helping emerging markets and all of that, that leads to ex-US growth rebounding. But for the time being, if you look at the economic surprise indices, they are suggesting to me that the US economy is holding up relatively well compared to other economies.
We're seeing that underlined with further data we're getting this week, particularly with the focus on jobs, of course, but the key will be those non-farm payroll data at the end of the week. But how is this playing out just as far as those treasury yields are concerned? You're saying perhaps has the market got it wrong? There is expectations of much deeper cuts to come towards the end of the year. Of course, we did hear from Jerome Powell, who pretty much indicated he only sees another 50 basis points before the end of the year.
Yeah, so again, you have to judge what is coming out of the Federal Reserve versus what is priced in the market. So Powell made his comment. The market is pricing a little bit more, right? So, like in a sense, what my judgment is that the market is going to be disappointed in the very near term because Powell is not going to deliver those rate cuts that are priced into the market for the year end. Going forward, yeah, I am totally in the camp that like the US can deliver like more massive rate cuts than what is priced in the curve, but that will be within the context of a really severe slowdown, given that a lot of rate cuts have already been priced. We're looking at closer to 180 to 200 basis points over the next 12 months. If the Fed delivers more than that, that will be within the context of a deep recession. And in that scenario, you would expect that, of course, bond yields would fall down. So you want to be long duration, but you would expect that the dollar will go up in that environment as well.
So when you look at government bonds there, where are you particularly, and you're sort of pointing out where perhaps conservative investors should remain overweight, where would you be?
In terms of government bonds, overall, you should be, I would suggest that you should be long duration. You should expect that government bond yields are going to come down over the next 6 to 12 months. If you want to make tactical bets, I would suggest that you probably should be underweight markets whereby rate cuts are not going to come down as quickly. So that will be Australia, Japan, in my view. Australia, because we're getting a couple of economic indicators that are telling us that market is a little bit more resilient. Japan, because obviously, despite what the new prime minister is saying, the economic indicators suggest that they are not going to be cutting interest rates anytime soon. And then you're going to be overweight the markets, whereby you expect bond yields to come down faster than what's priced in the curve. So that will be the Euro area, New Zealand, for example, and more likely the UK, which has been holding up relatively well. But we expect that, given what's happening in global markets, that could be repriced in the near future.
So once again, you feel as though the market's got it wrong as to where rates are going to go in Australia. They're not going to cut until at least next year then.
Yeah, so I think the rate cuts that are priced in the curves are accurate. Where I think the market has got it wrong is that the US is going to cut much faster than other central banks. And I just don't see that in the data. The US is holding up relatively well. If you look at the economic surprise index for the US relative to other markets, holding up relatively well. If you look at the interest rate sensitive sectors in the US compared to other markets, you find that other markets are more vulnerable to the past interest rate increases that have happened compared to the US. So I think that's the big mispricing in the markets, whereby the market expects that the Fed is going to cut interest rates faster and steeper than other central banks, and I think that's a mispricing.
And Chester, just returning to currencies then, and I was mentioning earlier about that support that the US dollar is attracting, certainly those safe haven currencies, in light of what we're seeing out of the Middle East. How do you see it longer term? What's at play, particularly for the US dollar?
Yeah, so I mean, I'm sort of positioning this near-term positive view on the US dollar, but it's always important to keep in mind what the framework is in terms of looking at currencies. And so what the framework is what's happening in the current global macroeconomic environment, what's happening in terms of valuation, and what's happening in terms of sentiment. So if we start with the macroeconomic environment, of course, Middle Eastern trends are positive for the dollar. They're positive in terms of the fact that you're going to be getting the safe haven flows into the US if we do have a like an escalation in the crisis, or more of an escalation in the crisis. But they're also positive in the sense that the US is simply the biggest oil producer in the world. So in a sense, terms of trade benefit the US if you get an escalation in the crisis. So that's the macroeconomic environment. Looking longer term, in terms of valuation, the US dollar is the most overvalued currency across major currencies. And looking in terms of sentiment, we've seen as well that, we've had a paring back of US dollar long positions, but a lot of the sentiment indicators still suggest that most investors tend to be positioned for a long US dollar position. And so longer term, negative, but shorter term, I would suggest that you want to be positioned for a little bit of an upside in the US dollar.
Just Ntonifor from BCA Research. Let's take a look at where we're likely to get going in a couple of minutes' time. SPI futures pretty much flat there, up just 3 points. So once again, looking for direction, and we'll see if we can find it in just a couple of minutes' time. Stay with us for the open.